Okay, so we've got two panels coming up. One, we're going to discuss some crypto best practices and get a little bit into the trading side, and then we're going to finish off with the Kentucky initiative to kind of, hit it off with the more exciting governmental work that we need to do here in Kentucky. But if even those are going to be on this next panel want to move their way up to the stage, and I need them to bring 2 chairs with them. So I think we've heard from everybody already except for you. So go ahead.
My name is Skylar Cobb. I work with Crypto Consulting Group here in Louisville, Kentucky, as a lead analyst and consultant.
Hot mic. Okay, so the conversation we want to have, I think, can be broken down in probably the things we've already learned, the things we are just now figuring out, and the stuff we're going to have to figure out if we're going to be successful at this. So I want to have you guys discuss a little bit from your history, the things you wish you knew if you were sitting out there beginning in the trading side that you don't really want to have to go through learning from experience, but can learn from wisdom. So pick one thing. We obviously could go real deep on that.
So some pitfalls we fell into early?
Yeah, things that you think, the scar tissue you have that you don't necessarily, that they don't have to go through on their own to figure it out.
As far as trading?
I mean, best practices in trading and picking investments. I mean, we kind of want to hit both pieces. I mean, I think they're very parallel. You're looking for very similar things when you're trading, although there are probably a lot more algorithms that do that work for you, But what are those what are the things that you've learned that you don't want to have everybody else have to learn on their own?
Yeah, I'll start it off with something that I kind of push to my clients who are newer in the space, and that is do your own research and due diligence. People say it all the time, and they really hark on it, but a lot of people fall into the trap of Reddit and Twitter and all of these sources that may be good to maybe gauge sentiment, but it's not good to get most of your information from if you're going to put money into an asset. And that was something in the beginning because I didn't have prior investing experience, that when I got on there, I just went to any source I could find right away. And one of those was Reddit, just to see the Reddit communities. And you can get a lot of good information off there, but there's also a lot of bias and a lot of shilling that goes on for coins and for projects that sound good, but they don't have all the technicals there to support it. So when it comes to doing your own research, it's not even just doing the top layer research. It's really digging in and making sure that even the research that you've done is accredited and it's a good resource to go to. So that's one of the biggest pitfalls, is to don't just go to your first source and don't go to the first thing you can find and just put money in because you're here.
Are you saying not everything is on the internet?
Yeah, exactly.
Don't believe what you do say.
Yeah, and don't believe it if it is on the internet.
Yeah, I can add. I mean, most of you guys heard kind of my pitfalls or learnings that I can take from the traditional equity space. But when it comes to trading crypto, I'd say know what your strategy is, or what you want to be good at, or what you are good at. And if I think about different ways to make money in the crypto space currently, I would put it in 3 buckets. One, which is kind of a fundamental, long bias type of investment strategy, which you might take a year or 2 or 3, however long you want to define that, where it's just truly an investment. You do your work and you make a bet on an investment. The second, which would be a more high frequency trading, where you're paying attention to technicals. So there's a lot of technical, a lot of fundamental people don't believe in technical analysis, but the thing is, when the market believes in technical analysis, then you can see the price action and come to fruition, and you can take advantage of those small inefficiencies. And then the third would be an ARB strategy. So whether that is intra-exchange ARB, inter-exchange ARB, or ARB against the futures product, you should really try to figure out what strategy you want to go for.
And when you say ARB, you mean arbitrage?
Yeah, sorry, arbitrage. So what that means is, like, let's say If you've noticed, trading Bitcoin or Ethereum or any of these products, they have multiple exchanges where they're listed. On one exchange, it might be $100, and another exchange, it might be 101. So an ARB strategy there would be to go long and buy the $100, token, and then go sell or short the $101, and you're capturing that spread of $1. And if you do that over and over and over with a high frequency, you can generate pretty safe returns. That would probably be the least, you would make the least amount of percent in a massive bull market like last year, but it would be considerably lower risk since you're kind of hedged out in your exposure, if that makes sense.
Yeah, I was just going to mention something to just reinforce a point you had made earlier. I think you have to give a lot of thought to a strategy for mitigating risk of keeping your funds on exchanges. And so I liked your point about just coming up with a percentage that you're comfortable with. I think you said 2%, kind of leaving on an exchange, overnight or something. So I think that's a good part of a strategy, because obviously the whole market kind of lived through the Mt. Gox implosion, and there's been a bunch of other examples of that. And so that's one of the early on things I like to try to tell newbies, warn them of that kind of level of risk.
Well, I think I'm seeing a fairly significant climate change in the ICO space where, one, there's the regulatory backlash where we're having to not just deal with our thesis, but deal with the market itself and its appetite. What would you see some of the concerns you'd have around investing in ICOs? And you've mentioned making sure that they back up their thesis, that they're communicating well, but also in terms of kind of that regulatory piece and making sure that you're not betting on something where you're going to be upside down in it. What are some of the thoughts you have in that space?
Yeah, so I guess in the U.S. you're sort of protected by SEC regulations in that generally for a lot of these ICOs, the companies themselves have their lawyers telling them they cannot market to U.S. investors. So you have, most U.S. investors have protection through that vehicle where you're probably not being marketed to for some of these deals. So that you don't have to really worry about that. But if you are part of syndicate groups that may invest through overseas vehicles, then you may be subject to some of these regulation risks. But that's on you. That's the risk that you take. In terms of when you're doing diligence, just if they have a deck and they're listing a bunch of advisors. Or their management team, look them up on LinkedIn. If those people don't appear, then you should question that. I know there have been a couple of projects where tokens and projects have raised a lot of capital, and the simple, basic due diligence process of looking up who that person is and did they do what they said they are or did in the past, that should be a red flag if you don't see them popping up on LinkedIn or any other site that they may post or market.
I will just mention there are at least a couple of examples now of these kind of level zero scam ICOs that have faked LinkedIn accounts, right, as part of their initial scam. So one of the things I was going to mention, and I don't know if this is straying too far from your point, but one of the things that still worries me when I look at ICOs is it just the way, there's a good thing and the bad thing about it is the money comes all up front, right? So, and obviously that's good if you're the one trying to get the funding, but the concern I still have is show me somehow how you're going to kind of continue to have an incentive to build out your platform or build out your project or achieve whatever goals you're trying to achieve once you've raised all the money. And it's just even with the best of intentions, as human nature, now if I have a big wad of cash, I just kind of lose that incentive, the drive to get the project done? And so
and some of that comes in metrics like governance and what are the lockup periods for the principals. What other characteristics? Miko Matsumura has the website icogovernance.org, and he's really pushing to make sure that we do some disclosure there and really get those issues on the table so that there's a level of comfort as well as, and maybe because I'm on a group of people that's in the older category, some experience on how to deploy capital, and having done some businesses prior to this, people keep suggesting, oh, you need to build a foundation. And it's like, really? Don't see where that's really worked so far in the marketplace, but I'm more than willing to have new models of governance. I just want to see working ones rather than the Tezos kind of scenario that we saw.
And I don't know what the answer is to that. It just seems like as an industry, we're not quite there yet. We haven't quite figured that. So whoever gets that model right, and kind of gives some assurances to the investor that, hey, we're going to put this gating system in place with some kind of milestones and some achievement goals.
In the past, fiduciary responsibility amongst the board of directors and the adults in the room, so to speak, there were equity components to it where their vested interest was much less liquid than what it is today. So, I think that's one of the challenges. While the liquidity is great for the investor, it can also be of high risk if the actual entrepreneur gets too much too soon. Right. Jason Calacanis gives a really good conversation about this in his book, Angels, where he talks about, wait a second, is it best to keep these people starving to death and desperate for liquidity? Or should we actually have them be able to feed their families and make a living at the same time they're building an entrepreneurial venture? And you probably have another perspective because you're helping people understand how to deploy capital into markets and look for those kind of risk factors as well.
Yeah, I would say with ICOs, because I try to break it down, our clients are entry level. So most of our clients are just getting into the space. And
are they investors in the public markets, or?
Yeah, so they'll be investors in the
Real estate?
traditional markets, and then they just try to figure out about the crypto space.
So this is diversification for them.
Correct. And one big thing that they ask us about is ICOs almost immediately because of the returns that they saw in the year of the ICO last year. And one thing that I tell them is it's already a risky asset class, cryptos. And now you're going to the absolute riskiest investment that you can make, which is an ICO. Most of them don't, or pre-ICO. Most of them don't have any product or anything out yet. It's simply a white paper and a team, maybe a governance model in there. And I just tell them to check it just like the other due diligence on other coins is you check their white paper, make sure it's technically sound, it makes sense. One thing that we do as well is we look to see if they've ripped off other white papers. Is it original? Have they actually gone into it and written it the way that they're...
So real people, real white paper.
Yeah, real people, real white paper. And real people is big too because you might have, like Eric Voorhees, he's had a problem with many people putting his name on an advisory board. Many times this has happened, many times. And that's something you can easily check. You can go check out to see if he has on his site that he's an advisor there. And if not, Twitter's awesome. You can DM or at them on Twitter or Facebook or LinkedIn, and they'll answer half the time. If their name is associated with something that they haven't approved, they'll answer half of the time. So I just tell my clients when they're looking to ICOs, one, I let them know it's already a risky asset class and you're going to the most risky investment, but your due diligence has to be 2 times as strong. You have to make sure that it's a really sound white paper. They don't have a product yet. Yeah. They don't, they're in the very beginning step. You're angel investing at that point.
Angel is really the book I recommend people read. Jason's done a good job of identifying that model. I think one of the challenges is just hearing that entrepreneurs are now an asset class is kind of an interesting concept because, it used to be that 9 out of 10 of these startups would go out of business, and out of that would potentially be the next one. But the whole motive wasn't to build built-to-last type companies. It was built to flip. It had to fit the model for VC. It had to fit, it had to be a unicorn. Sorry, I know where we're sitting here. But, I think there's a way to build unicorns that doesn't have to be flipped to a Google or a Microsoft.
Right.
So that's my thesis in business for the last 25 years, and that's why I haven't taken that much VC in my life, is that I'm not looking for leverage, I'm looking for, potential, which I think is what we're here about.
Yeah, I think in the future you'll see more defined, some people call it TRS or token release schedules. basically trying to address this problem. I know with the projects that we're advising on, more increasingly we are kind of suggesting that management take these types of approaches because the market is evolving. The days of just throwing together a white paper and raising 10 million bucks, I think, is over. I think, you know, through this last cycle we saw in 2017, with that brings more investors, but at the same time, as we get more institutional investors, they will demand institutional frameworks that are typically a little bit more stringent, rely heavily more on due diligence side, valuation, and so forth. So in some ways, it's good for the market because more money will come in, and when the institutions come in, you will have a larger market. But at the same time, it does make it harder for some of these tokens with weak white papers or weak management teams to really be successful.
So I've got the job of kicking us back on time if I can. So I think what I'd like to do is open it up for any questions from the audience, just so that we can fulfill any interest of this panel that you guys would have out there. And then obviously all these gentlemen are available through the rest of the conference for one-on-one conversations as well. Oh, yeah, let me take your mic.
Just one quick question to Tim. You talked about what's the incentive for these guys once they get these huge influxes of cash. Vitalik kind of talked about in the DAICO having milestones where the funds raised are released at those milestones alongside the roadmaps that they've put up to attract these investors. What do you think about that idea?
No, I mean, I think that's the right approach. I just, like I said, I don't think we've kind of figured out the industry hasn't perfected that model quite yet, or at least for me, it still seems like, I mean, I've like you said, these TRS schedules or whatever, all these things that I think are an attempt to answer that. It just doesn't seem like we've quite gotten there, at least in my
There
mind.
is that pivot problem where we find out something doesn't work, and now the milestones we said we were going to do are all redo. I think that's always the challenge, is to build a certain level of accountability. You know, obviously with blockchain we get some of the visibility into it, but then how do we actually get to the ability for the entrepreneur to have that relationship with the investors or the stakeholders? And I don't think it's always the court of public opinion that's going to be the appropriate one for that. So I think that governance piece, you're right, we're early. Anybody else while we're finishing up here? Okay, so I feel like everybody should at least get up and walk around a little bit, and then maybe grab a beverage and come on back, and we'll finish up with the Kentucky. And I don't remember the name of the
Kentucky Blockchain Alliance.
Kentucky Blockchain Alliance.
All right.